How many zeros are in $1 trillion? 12. A sum of money that is hard to imagine. But that's more or less what investors pour into the fossil fuel sector every year, even though many have said they'll stop. Like a lifelong smoker telling you they're going to quit while lighting one last cigarette. So why are investors still hooked on fossil fuels? And how can they kick the habit? 2024 was party time for fossil fuels. We burned more gas, oil and coal than ever before. Companies got more licenses to look for more oil and gas in areas about the size of Sweden. And instead of winding down, the industry is expected to keep growing in the coming years. This is of course not how to stop global warming, but it is happening because of those trillions of fossil fuel investments. I wanted to understand how this is possible, so I brought along some little protagonists. This fossil fuel company wants a new gas field or a pipeline maybe, or say an LNG terminal. So it goes to a bank, just like you and I would. But it wants millions and billions of dollars, and that's often too much for one bank alone. So that bank teams up with others to spread the risk and grant one big loan together. That's called syndication. The fossil fuel company takes the loan to expand its business and pays it back with interest.
It's a sector which is still very profitable, especially in terms of high returns, especially in the short term.
Nadia Amelie studies the links between the energy and the banking sectors. With other researchers, she looked into thousands of deals between 2010 and 2021.
And something that we notice is that, as I say, in order to secure the capital for a deal to happen, it was this basically pool of money that was provided by different actors, by let's say 10 or 20 banks. So we can see some clear patterns where banks that do pair historically with some same partners.
When it comes down to it, fossil fuel finance is a surprisingly small community. On the industry side, aka Big Oil, there's Aramco, ExxonMobil, Chevron, Shell, BP and a few others. Just 8 companies own half the market for oil and gas. On the finance side, it's the same picture. Just 30 banks cover almost 80% of investments.
Even if over time we see some banks reducing their exposure, when we look at the total finance provided to the sector, actually the total amount was always the same. So that means someone else stepped in.
Another way banks help to raise money for fossil fuel companies are bonds. These are loans that get chopped up and then sold to investors. For example, if the company needs $1 billion, this could be done with 100,000 bonds worth $10,000 each. Not just banks buy those bonds, it's asset managers, funds and insurance companies. And you as a private investor can also buy fossil fuel bonds, but even if you don't, chances are your bank savings or retirement investments are already there. The fossil fuel company pays regular interest to the bondholders until a set date, when they pay back everyone for their initial investments. Since the 2015 Paris Agreement, the 60 biggest banks have invested around $7 trillion into the fossil fuel industry via bonds and syndicated loans. Steady profits, low risk and a well-established community. For banks, fossil fuel investment must sound like a no-brainer. If only it wasn't driving the climate crisis, yet investors are also well aware of what that means.
We know that climate change is a fundamental material risk.
In fact, for a while, big finance was talking down fossil fuels.
Capital is moving, and it's going to move very rapidly.
We have formed a net zero task force
to get to net zero in terms of our financed emissions by 2050.
In 2021, the United Nations got many big fossil fuel investors to join initiatives committed to net zero emissions by 2050, which would have pulled a lot of money out of oil and gas investment. Okay, the commitments were entirely voluntary, but still on the surface, the financial world seemed to be changing until this.
Russia launching a full-scale invasion of Ukraine with attacks on targets across the country.
Russia invaded Ukraine in 2022 and cut off cheap gas and oil for Western Europe. The EU scrambled to find new supplies, and there was unrest around the world as energy prices spiked. So governments jumped in, paying $1.3 trillion in subsidies to producers and consumers of fossil fuels, more than ever before. Instead of running out of money, the fossil fuel industry returned record profits. Big investors quickly reconsidered how green they really wanted to be. And then this man came back.
We will drill, baby, drill. We're going to drill, baby, drill.
Like dominoes, all the big US investors left the net zero initiatives, while at the same time saying they were still committed to net zero emissions. We wanted to hear from those banks and asset managers how exactly they think this is going to work, but only got this. One big investment company told us off the record that as long as fossil fuel demand is there, money will be invested, and that it's up to politics, tech and us consumers to make investors shift their money. Meaning, as long as a small group of people still make a whole lot of money from fossil fuel investments, they won't kick the habit themselves. But there's hope. Let's take a step back. There are other big investors with a lot of sway: insurers, trusts and funds, pension funds which pool and invest their members' retirement savings, for example. These folks are usually not after a quick buck. They want to safeguard and steadily grow their money over long periods of time, and have done by investing in the fossil fuel industry. They do it with bonds, which we saw earlier, but more of their money flows into shares. Owning shares means owning a part of a company itself. Ideally, the company does well and the value of the shares grows. And the shareholder's initial investment is worth more. Unlike loans or bonds, buying a share in a fossil fuel company usually doesn't provide it with fresh money, but it does keep the company's market value stable. And some investors aren't willing to do that anymore.
We want to create not only good investment results, but we also want to do it in a responsible manner.
Anders Schelde works for a pension fund in Denmark that manages around $22 billion. Until a few years ago, around $1 billion of that was invested in companies like ExxonMobil, Shell or BP.
Looking at all those different climate scenarios, so to speak, we ended up with a negative long-term view on their investment performance. And that was really the main conclusion for us, driving our decision to divest the sector.
Divestment, or pulling investments out of fossil fuel companies, has been growing steadily in recent years. According to a non-profit database, more than 1,600 organizations managing more than $40 trillion have committed to either fully or partly pulling out their money from the fossil fuel industry. Among them are many churches and universities, but also a couple of large funds. Supporters of divestment cite two arguments. One, they want to avoid financial risk. Declining fossil fuel use would see the sector shrink and investments could end up stranded. And two, they want to stop climate change, which means no more fossil fuels. For Academica Pension, that meant, for example, shifting their big oil investments to renewable energy companies like wind energy giant Ørsted.
We put in also a clause in our divestment decision that states that we can reinvest in a given oil and gas company, provided that we have faith in their long-term transition plan. But so far, we haven't been able to conclude that any of these companies were on the right path.
It is still not clear how a divestment is really impacting fossil fuel finance, apart from a signaling effect. The overall amount of investments hasn't changed. For every divestment, another investor seems to jump in. So if voluntary measures aren't enough to break the addiction, what else can help?
Like a public, transparent assessment of the financial sector of a country and its exposure to the fossil fuel industry. The French regulatory authorities are doing that, which kind of enhance like a race to the top within financial institutions in France.
Katrin Ganswend researches fossil fuel finance. The idea is that laying fossil fuel investments bare increases pressure to transition from fossil fuel to renewable energy investments. France has also tightened international standards for green investment, the ESG criteria, which are often criticized for giving loopholes to fossil fuels. Similarly, strict rules apply to investors operating throughout the EU. Such regional action is a start, but finance is global. And so, global regulators would need to set up similar rules to really put an end to fossil fuel investments, according to Nadia Amelie's study. For example, they could limit banks from stepping in when another pulls out its investment. And if enough big banks could be pressured into divesting from fossil fuels, the knock-on effect could change the entire financial sector. But that's a big if. Truth is, the fossil fuel industry is still getting a lot of finance with no end in sight. But there's a twist in this story.
The most active banks in the fossil fuels are also those that are most active in the green sector.
Most investors don't put their money into fossil fuels because they like it. They do because of the profits. That's likely going to change at some point. And we are already seeing it. For every $100 banks invest in fossil fuels, they now put $89 into wind, solar or grids. Most of the new energy capacity being added today comes from renewable energies. They're just far cheaper than digging for coal or drilling for oil and gas. The question is when investors will fully kick the fossil fuel habit. Some already have, but the big and quick change that we need will only happen with tighter rules. Do you know what your bank is investing in? Let us know in the comments below. Subscribe for more videos like this and check out dw.com for more stories.